Hey everyone, hope you're well. This is the summary for weekly report number 17 for the weekend in April the 5th, 2026. The summary this week is US equities snapped their losing streak, which on the surface is something for bulls to celebrate, but beneath the surface, where our distributional thinking lives, almost nothing changed. In markets, all four US indices finished green this week. In the majors, the S&P 500 and Nasdaq Composite led the way with 3.36% and 3.95% gains respectively. The VIX dropped 23.1% to 23.87 in a sharp compression, but this sentiment-driven compression isn't actually structural repricing. Gold and Bitcoin also enjoyed positive weeks this week. This entire rally happened realistically in a single day, Tuesday, March the 31st, and it was one unconfirmed headline that initiated it: Iran was open to talks. By Thursday, Iran had shot down a US F-15, mediation had stalled, ceasefire conditions were rejected, and the Strait of Hormuz was still closed. To me then, this had all the anatomy of a short cover rally. Positions build on the way down, a catalyst hits, and shorts rush to buy back and lock in their gains. That buying looks like conviction, but it isn't. It's just positioning being unwound and nothing actually changing under the surface. When that pressure fades, often so does the rally, and this is the risk we're protecting against. So, diplomatic hope faded and physical markets repriced this almost immediately. Elsewhere, NFP printed 178,000 new jobs this week, well above consensus. But if you strip out the Kaiser strike returnees, the organic number's closer to 102,000. ADP said 62,000, so quite the spread in the jobs numbers. ISM manufacturing prices also hit 78.3, which is the highest since 2022. And this signals that jobs are inflated as prices are screaming, and that's stagflation risk shifting the distribution slightly to the left without even considering the Iran situation. On that Iran situation, OM oil, the physical Gulf disruption benchmark, rewidened 7% to $116.88 a barrel. OM oil is the metric that best represents the risk premia for Gulf crude transit, so it's a more compelling metric than the narrative coming from Washington. Ultimately, sentiment led last week, and the distribution of potential outcomes didn't follow. The headline numbers look reassuring. Volatility is down and markets seem calmer, but nothing underneath has actually changed. There's been no improvement in the distributional risk. The VIX is lower because sentiment shifted, not because risk disappeared. OM oil rising again tells you the physical reality hasn't changed. Same numbers, completely different distributions. So in summary, price bounced, the distribution didn't move, and that gap is where mistakes get made. No changes in the Valkyrie portfolio as a result. One green week doesn't shift the risk materially for me. This full report's now live on Substack, including 37-minute podcasts for those that prefer to listen. Subscribe to escape the wealth illusion to be notified of all new releases in your inbox every week.